Good morning, and welcome to episode 40 of Getting Rich. I'm your host, Rich Checkan, president of Asset Strategies International, and today is Wednesday, August 18th, 2021. Over the past week, there were two major headlines that dominated the news. The first being the withdrawal of U.S. troops from Afghanistan. Unfortunately, as the U.S. troops are withdrawing, we're seeing the Taliban in record time recapture all the major cities. This is reminiscent of Vietnam in 1975, and I'm sure there'll be a lot of parallels between both of these conflicts, which failed to produce any sort of real return at the cost of a lot of bloodshed and a lot of money. The second newsworthy item was the passage of the $1 trillion infrastructure bill this past week. That is the first of two that are on the table. The second is a $3.5 trillion human infrastructure bill, whatever that means. Both of them are looking like they'll be approved, and both of them are going to be paid for with money that we don't have. Enter the printing presses. That's something, by the way, that is possible as a result of an event 50 years ago this past Sunday when President Richard Milhous Nixon basically closed the gold window, ending the convertibility of dollars to gold and vice versa. And ever since, we have not had to balance our checkbook as a country. We've been able to spend more than we take in just by printing more money. And we'll talk a little bit more about the money supply in a second. This past week, with the conflicts going on, and as a reaction to the flash crash the beginning of last week, the metals have rebounded for the most part. Palladium actually didn't suffer last week, and it finally succumbed and pulled back over this past week, but most of the metals fared well. We continue to see inflationary pressures mount, but in my opinion, that's not the biggest reason why we should see gold move higher in the future. If you look at a long-term graph of gold versus the money supply, as the money supply increases, so does the price of gold. There's no surprise there, as there are more dollars out there in the marketplace chasing after a finite number of goods and services. The power of that dollar dilutes. It takes more of them to buy virtually everything. So I'd like you to keep your eye on the money supply going forward. As it continues to increase, so do the prospects positively increase for gold prices going forward. I want to talk a little bit about the pricing of the metals from this past week. Gold, like I said, did rebound. It's up about 3% to $1788. Moving up toward that $1,800 level from $1738.20 last week. Silver is up 1.5% to $23.79 versus $23.46 last week. Platinum is down 1% to $1,006, just over the $1,000 level from $1,017. And like I said, your big loser this week was palladium catching up with the pack on the downside, down 5.5% to $25.91 from $27.45. You saw a slight uptick in the gold-silver ratio. It's taking 75.43 ounces of silver to buy 1 ounce of gold versus 74.37 ounces last week. And the dollar is virtually unchanged at 93.10, down slightly from 93.16 last week. This coming week, we're going to have an opportunity to answer some of those questions that are on people's minds. We talked last week about the frustrated gold investors wondering when gold and silver are going to respond. I'll be on the Money Show Metals and Mining Conference, August 24th to 26th. I'll actually be on with a presentation entitled Use Gold to Fight Inflation and the Everything Bubble, from 11:15 to 11:45 next Tuesday the 24th. And I'll be on a panel with Adrian Day of Adrian Day Asset Management and Brian London, the producer of the New Orleans Investment Conference. Our panel topic will be when and how will gold, silver, and mining stocks respond to inflation? and that'll be from 4:30 p.m. Eastern to 5:10 Eastern on Tuesday the 24th. It's free to join, folks. You can see the information below to sign up. Please register and join us, and hopefully we'll answer some of those questions for you. As always, we'd like you to subscribe to our YouTube channel and leave us any comments, questions, like us obviously, follow us on all the social media, subscribe to our newsletters, and please don't ever forget that getting rich starts with keeping what's yours.